Specifically in this video, I want to talk about tax loss harvesting, which is one of the things that you can be doing with your investments to really control your taxes and utilize current losses to offset realized gains and even a little bit of income. So as I traditionally do, we'll go through an example here to showcase what exactly tax loss harvesting is and ways you can use it to optimize your finances. Now, it's important to recognize tax loss harvesting is really focused on taxable investment accounts. So these are often called your number one investment account, your brokerage account, your TOD account, your JTWROS. These are all accounts that normally when you're making investment activities in them, those activities are taxable, right? If you have any gains, you typically pay taxes. If you receive dividends, things like that. This is not applicable to retirement accounts. With retirement accounts, you'll remember, only care about money going into the account and coming out of the account. Really what happens in between the account doesn't really matter. Hopefully you're just doing the best of your ability to grow it. But within the taxable account, the typical activities are all taxable, so therefore we can leverage a strategy like tax loss harvesting to be more mindful of the ramifications of our investments. So in this example, we have $15,000 in losses. And it's important to recognize these are realized losses, not loss that's sitting on your position laying out as unrealized, but a position that you've actually sold and triggered the loss using, okay? And with this, you are now sitting on this, which can then be used to your advantage. So let's say in the same example, you have $10,000 of realized gains. So let's say again, they are not sitting in as a position, but you've actually gone ahead and sold the position and would otherwise normally be paying taxes. Now recall, if you've held the position for less than 1 year, these are short-term gains, typically taxed at your ordinary income rate, which is your marginal tax rate. So it's unfavorable. It's typically a bad tax. Over a year, these are long-term, and that is taxed at the capital gains rate, which is favorable. So ideally, you typically would be holding these for over a year before selling in an ideal tax scenario. Now, it doesn't really matter in this case. Let's just assume it's a combination of positions that you've sold and realized gains, and those positions added up to $10,000. Now, in this case, you're going to be able to leverage this $15,000 to offset these $10,000 in gains. So you can wipe those out, and you're left over with $5,000 of losses after that happens. Well, the good thing about the tax loss strategy is you can actually then use another $3,000 to offset your taxable income. So, for example, let's say you made $100,000 of taxable income. You could now take $3,000 against that $100,000, making it so that your taxable income is only $97,000. Now, it's often not going to be a total game changer, but it is helpful to know about because you've just saved yourself a little bit of money that otherwise would have been going to Uncle Sam. Well, that means now you have $2,000 of losses that still haven't been used. So what happens with those losses? The good news is you can take those losses and carry them forward indefinitely to 2021 and beyond. Ultimately, where they'll be waiting to be used for any future gains or to offset any future income that you'd like to. So it's nice because it's not a use it or lose it feature. So obviously this example kind of perfectly drew this out for you just so you could showcase it, but in a situation where you had even more losses, you could technically still carry those forward so that they could be utilized over the course of multiple years as the rules stand now. Now it's important to recognize, of course, we're never really hoping for losses, right? We go into investments looking to make money, but why I think tax loss harvesting is so important is, number one, I meet with a lot of clients initially who are really anchored to their positions, right? They've seen a position where they put in money, that position has lost value, and they really care about that purchase price. They're always kind of really trying to get back to break even. It's really an important milestone for them. But unfortunately, when you have that approach, there's an opportunity cost to where that money could otherwise be deployed, right? If you don't like the position long-term to begin with, the market doesn't really care what you paid for it. So one, you may never even get back to break even to begin with, but number two, that money could probably be put to better use in another area where you might see a more sizable return. So the ability to now forget about that anchor price and realize, hey, let's take advantage of this loss while we have it because we don't really want the position anyways, becomes a real benefit from a behavioral standpoint in helping people get out of positions that they were formerly tied to. Now, the important thing to note there, though, is if you do like the position long term, oftentimes it's not really worth trying for this tax move, because markets can move fast, right? And the last thing you'd want to do is get out of a position just to generate a loss and then try to time getting back into the position after 30 days because of wash sale rules, only to then see the position pop and run up on you. That obviously would be a very frustrating scenario. And I think of the tech stocks in particular, where that has certainly happened over the course of time. Many of them have seen significant drops only to rebound on their way to higher highs. So the point of that is, long term, if you really like the position, maybe a strategy you want to ignore. If it's a position that you're looking to get out of anyways, or really don't have a serious long-term opinion on, tax loss harvesting can be a phenomenal opportunity for all of the reasons outlined here, on top of then the behavioral benefit of maybe helping you move along as opposed to really caring about that initial purchase price. All right, so that'll do it for tax loss harvesting. If you learned something today, I'd really appreciate it if you could go ahead and hit that like button. It's a new channel and it helps the audience grow, helps new users find the channel. It would go a long way and really be appreciated. If you really enjoy this type of content, you can go a step further, and I'd encourage you to subscribe, turn on notifications so you get notified when any new videos come out. I'll be coming out with a lot more of these videos, especially as we close out the year. A lot of information on ways to save effectively, grow your money, and reduce taxes. Thanks again for tuning in. We'll see you in the next video.